The assessment of how much luck contributes to the success of each type of investor is quite an approximate matter and is based on overall experience. This is because short-term stock returns are often influenced by volatility and random events, while long-term investments are largely influenced by the fundamentals of a company and the economy as a whole. However, here is a rough example of how much success can be attributed to luck, i.e., timing the market or coincidences, over a given investment period. 1. Invest for 1 week, sell within 1 week, approximately 70 to 80% depends on luck reason, in a short period of time. Most returns depend on market volatility and precise timing, which are difficult to control by skill alone. 2. Invest for 1 month, sell within 1 month, approximately 60 to 70% depends on luck reason. Even with a little more than a week, the short-term market is still very random and changes rapidly. 3. Invest for 1 year, sell within 1 year, approximately 50 to 60% depends on luck reason. To some extent, you can use fundamental and technical analysis to help, but there are still effects of volatility and unexpected events. 4. Invest for 3 years and sell within 3 years, approximately 40 to 50% depends on luck reason. Longer periods allow the company's fundamentals to play a greater role, but there is still risk from market conditions at each time. 5. Invest for 5 years and sell within 5 years, approximately 30 to 40% depends on luck reason. In the medium to long term, fundamentals and management will have a greater impact on success, while market randomness will start to have less impact. 6. Invest for 10 years and sell within 10 years, approximately 20 to 30% depends on luck reason. Long-term investment reduces the impact of short-term volatility and has a greater impact on the growth of the company and the economy. 7. Invest for 20 years and sell within 20 years, approximately 15 to 20% depends on luck reason. The longer the period, the sum of the true growth of the company will play a greater role and reduce the dependence on random factors. 8. Invest for 30 years and sell within 30 years, approximately 10 to 15% depends on luck reason. During this period, short-term market changes have less impact and the long-term trends driven by fundamentals and company management are the main drivers. 9. Invest for life, approximately 5 to 10% depends on luck reason. When you hold stocks for the long term, the short-term random factors are almost averaged out, and success depends on selecting companies with strong fundamentals and proper portfolio management. Note: these figures are rough estimates that try to show that short-term investment tends to rely more on luck than long-term investment. Investors who use careful analysis and planning over the long term will reduce the risk from market randomness more. There is no exact formula because the stock market is complex and factors have different effects at different times. Overall, if you want to reduce the dependence on luck and volatility risk, you should look at long-term investment along with studying fundamentals and careful portfolio management.